Welcome to the video on control accounts. There is a more detailed video on control accounts with figures and calculations in my full course, see the link below. But what I'm going to do today is go over how we deal with a trade receivables control account or a sales ledger control account, and sort of just go over the basics. So within the nominal or general ledger, we will have a T account for all of our credit customers. So one account that will keep track of how much our credit customers owe to us. Remember, when we make credit sales, they're sales where we are not paid at the time when we've made the sale. The customer's taken the goods or the service but not paid. So these credit customers owe us money, and we have an account that tracks or keeps account of how much we are owed in total, and it's called a sales ledger control account, or the trade receivables control account, or the receivables control account. So you could actually have that name. What it is the total trade receivables, the total of how much all the trade receivables owe to us, or the total of how much all the credit customers owe to us. Now we have a memorandum ledger called the sales ledger or the trade receivables ledger, which is when we have individual accounts for each credit customer, for each trade receivable, each person who's taken goods or services from us and not paid. We have a separate account for each one of them in case we want to know how much each one owes us. When we make a phone call to chase payment, we can see how much they individually owe and we can chase that payment. So we will have the individual accounts inside the sales ledger, or what we could call the trade receivables ledger, and we have all the trade receivables in one account here called sales ledger control account, trade receivables control account. And you can see the wording, the sales ledger control account is to control or check up on the sales ledger, or the trade receivables control account to just make sure that we can verify the figures from the control account with the actual sales ledger or trade receivables ledger balances as well. So in other words, what the individual credit customers owe us on the individual accounts should add up to the same amount that we're owed on the total account. So this account represents amounts owed to us from credit customers or customers who've taken goods from us and not paid at the time. So we are owed money. When we're owed money, then we can understand that this account is an asset account. If you don't understand how double entry generally works, go back and look at that video on double entry. But asset accounts increase on the left, and the value of those accounts decrease on the right. So in other words, this is an account that represents how much we are owed by our credit customers. If that amount that we're owed, if that asset increases, the figure goes here. If that amount decreases, the figure goes on the credit side, the right hand side. So let's have a look. So what we start with is the balance at the beginning of the year, the balance brought down. And since this account is usually or supposed to be an asset account, amounts owed to us, then assets have a brought down on the left. So the balance brought down in most usual cases is going to be here on the left hand side on the debit. Then if we make credit sales, we make sales to our credit customers where they don't pay us, then that will increase the asset, increase how much we are owed. So if we make more credit sales and those customers do not pay at that time, then the amount we're owed will increase. So any credit sales will go on the increase of the asset. Our asset of trade receivables is going to increase because we're owed more. So the double entry for that would be, we would credit the sales account. If you want to know the double entry, we would credit the sales account and debit the trade receivables account like we've done. So debit on this side, left side. And if we've made credit sales that the customers are not happy with, they will return those credit sales. And if they return goods they brought from us, that will reduce the amount we are owed, they'll reduce the asset. So any credit sales returns will go on this side. There is a double entry for all of these. We're focused on the control account at the moment. Now, if the credit customers make a payment to us, which is what we hope that they will, then that's going to reduce the asset, reduce the trade receivable, reduce the amount that we are owed after that. So they make a payment to our bank, we'll put that on the credit side here and debit side of our bank. So the payment will debit our bank account and credit the trade receivables account. If we allow our trade receivables to have a discount is supposed to reduce the amount that they owe us. That's the whole point of a discount. So that discount allowed is going to go on the credit side. Now, when we do this for our trade receivables, if one of the trade receivables, let's say trade receivable number 2, makes a payment to us, we would obviously credit the receivables account, but trade receivable 2 in the sales ledger or trade receivables ledger, we would also credit that to keep account of how much that particular trade receivable now owes us. If trade receivable number 2 has made a payment to us, trade receivable number 2 will owe us less. So we have to obviously credit the account for trade receivable 2 to denote the fact that trade receivable 2 owes us less now. But we'd also put it into the total account because this keeps a track of all of them put together. Other things that could happen, if we have people who have returned goods but then we refund them, that will increase what we are owed. So a refund that we give for returned goods will increase again back up the asset. It will go on the left. Now if we have a payment received, if our customers have paid us a check that goes into the bank, we would say that we've received the money and reduced how much we are owed. However, if upon inspection that check never actually comes through, if the check bounces, then that payment never really happened. But we have at the moment put it into our accounts. So if a check actually later on, a few days later, the bank tells us the check has not come through, it has bounced, then we need to cancel this check that's inside the trade receivables account. So since we've put a figure on that side, the way we cancel figures in accounting is we counterbalance them on the other side. So if a check is dishonored or has bounced, so that will go on the debit side to counteract the fact that we originally accounted for that payment as received when it actually wasn't. So we have to cancel that off on the other side. Okay. Now, if we have allowed a discount, and if that discount was for a payment that we received, or we presumed we received, but that payment actually never came through, then the discount we allowed is also void. But since we've actually put that discount in, then we would have to cancel the discount as well on the other side. We cancel things in accounting by putting them on the other side. Cancel discount allowed for the amount of the discount that was related to the payment that we presumed we had got. To cancel discount allowed goes on the left of the debit side. The discount allowed itself goes on the right or the credit side. Any contra or set off amount, so a contra or set off always will reduce any debt either way. So we're looking for the reduction side, which is that side. And lastly, when you balance this off, you'll have a balance usually on the credit side, because usually the balance brought down is supposed to be on the debit side like it was at the beginning, but it can switch. If, for example, people who owe us money make a payment to us and that goes in our bank, but for way too much, then in fact we end up owing them at the end of the year, and the balance carried down and brought down can switch sides to the other side. But that is the side that we normally expect transactions to go on inside a sales ledger control account or trade receivables control account. To end, just a couple of summary points. Something that students often get confused with is cash and how it affects trade receivables. So I'm just going to say a couple of things. One is that if we do a cash sale, remember a cash sale is one where we make a sale and we physically get the money straight away, either as cash or into our bank. So a cash sale is one where the payment is received straight away. So that's like when we go to the shop and we buy something, we make a payment straight away, pay cash or with our card, and that transaction does not create an increase or decrease in any debt. So if you have a cash sale or a cash purchase, it doesn't affect debts. It doesn't increase or decrease your debts. So if we made a cash sale, it does not increase the asset of trade receivables and it doesn't decrease the asset of trade receivables. So a cash sale does not go into a trade receivables account. Only a credit sale will go into the debit side of a trade receivables account, because a credit sale means that we made a sale and the customer has not paid at that time, so that will increase the asset, increase how much we are owed. And one final thing is that when we are paid cash by customers who owe us money, by credit customers, that does affect the asset. So if these people who owe us money pay us, that will reduce what they owe us. That will reduce the asset. So therefore, if it reduces or increases the asset of trade receivables, it will go in the trade receivables account. If it doesn't increase or decrease the asset, then it doesn't go in the trade receivables account. So if we're paid cash or as a bank transfer from the trade receivables, it will reduce the asset, reduce how much we're owed, so it will go on the reduction side, the credit side, or trade receivables. Whereas a cash sale doesn't affect this at all and doesn't therefore go in it. Okay, and for more detail and to look at trade payables in more detail, visit the full course in the link below.